Let's connect with them. But at this point in time, of course, we'll thank Dipin, we'll thank Kunal as well. Harsha, good morning. Nice to have you back on ET now. Let's start with the basic question. What is your market view? First half was, we were pitted against a lot of news flow, but I think markets have done reasonably well. Second half of this calendar year, what is in store?
Good morning, Nikunj. I think clearly market at this point of time lacks big triggers on either side. So to that extent, probably is going to consolidate at around current levels. Valuations have been on the higher side, but at the same time, the macro environment has been quite benign. And also if some of the tariff issues and geopolitical issues resolve over the next couple of months, then probably that should also add to positive sentiments. However, when you look at it from a more bottom-up perspective, you are not really seeing earnings growth trajectory changing at this point of time. That still is something that we will want to see if markets were to move higher. Our expectation is probably in the second half, we will see some sort of pickup in earnings growth, but it's still not going to be very, very exciting. But from the levels that we have been for the last couple of quarters and probably in this quarter as well, the first quarter of financial year 26, we should be able to see some bit of improvement in earnings. And also we are expecting some little bit of improvement in credit growth. So all of these factors should enable markets to inch higher in the second half.
With such solid macro conditions, low interest rates, abundant liquidity, good monsoon, inflation coming down, interest rates down 100 bips, earnings are not coming. So the question is that if they've not come yet, why will they come now?
No, I think usually it takes a little bit of time for credit growth to pick up. And usually once the credit growth picks up, you will see all around improvement. While things have been fine at the macro side, we have really not seen a dip in commodity prices, which is also crucial for margins to inch up when the volumes are not coming. So I think there are a couple of factors which still need to get addressed. And we think that over the next couple of months, couple of quarters, we should be able to see that. While the margins will be overall okay, but I don't think you can see much of an improvement with lower volume growth. And a higher level of volume growth would be possible probably when rural economy starts to do well, or some of the pricing issues are sorted out in some of the other areas. So overall, I think, yes, clearly that's the reason why markets don't have much of steam at this point of time to really move higher unless liquidity pulls it up, given the fact that things have not been so great at the corporate earnings level. However, if you go back and look at it from a historical perspective, whenever macroeconomic factors start to kind of become benign and supportive, over a period of time, you will see corporate fundamentals also get better. And that's the hope that we have at this point of time.
So Harsha, where are your biggest overweights and underweights in the market right now?
Aisha, clearly we still are tilted more towards domestic businesses. That's where there is a lot of resilience. At least there is some bit of earnings growth, some bit of volume growth. There are no headwinds like what's going to happen on tariffs, etc. So that's the pocket where we have been overweight at this point of time. It would be different in different funds, but generally financials, cement, capital goods in some portfolios, oil and gas in some portfolios. We also have exposure to telecom, power, etc., which are all domestic oriented and have very little to do with overall tariffs or some of the issues that are there in the global market in terms of growth. We would wait for another couple of days to really see what happens on the tariffs for India in specific. After that, we'll probably review some of our export-oriented positions. We do have overweight on one of the export-oriented sectors, which is chemicals, where we believe that India continues to have a relative competitive advantage over some of the others, which are likely to have higher tariffs than us. So, and also industry has seen a bit of a turnaround in terms of some improvement in margins, some destocking that has helped the overall industry, etc. So that's the only pocket among export-oriented sectors where we have an overweight. Rest all are domestic-oriented.
Right, Harsha. So appreciate that view. Hi, morning. Also wanted to get your sense on where amid the broader end of the market, if at all, you are liking any sectors, any stocks, because as I understand, you're more positive on the larger end, but what's your view on the broader end? Do you believe that now is time for the large caps to take the lead ahead for the markets, or do you believe that there is some value on the broader end?
The broader end continues to be at a valuation level which is higher than historical levels and higher than large cap for quite some time now. Although we did see more volatility in that bucket maybe at the beginning of the calendar year. But post that, again, we've seen a broader end doing much better than large cap. So to that extent, from a pure valuation perspective, there is no sectoral pick in that market, in that end of the market. We would be more stock specific and bottom up in terms of our evaluation. And wherever we can take slightly higher large cap position in some of the funds that we have been doing, that's broadly in view of the relative valuations that are there between large caps and non-large caps, I would say. But otherwise, we are not negative on mid or small caps. So we are just saying that if you're coming into mid and small cap strategies, please do come with a slightly longer term horizon compared to large caps, and also be ready with slightly higher volatility given that they are trading at a higher valuation. And that's what our view has been.
Okay. Harsha, let's look at the current setup, which is inflation is down, crude is down, dollar is down, and yields are also down. These are classic indicators that the macro trade should do well. So are we in for a macro outperformance, which is banks, NBFCs, interest rate sensitives? Are we in that patch now?
Looks like, Nikunj. And in fact, if you look at financials, they have been outperforming for the last couple of quarters. May not be by a wide margin. You may not have seen very, very large absolute numbers from that portion of the market, simply because markets have gone nowhere. But clearly, there has been an outperformance. And we do believe that that segment will continue to do well. And over a period of time, you should see that outperformance increasing and becoming more visible. Given that our expectation is of a improvement in credit growth over the next 12 to 18 months.
Harsha, I was just going through your fact sheet, and it's quite intriguing to know that the way to play defense, according to you, is via aerospace. Tell me, what is it that you find interesting about this pocket, and if you can just identify some themes or companies within that.
Aisha, we have been very positive on defense for quite some time now, and we started building our positions when the government started to focus on indigenization, and also larger investments continue to happen into defense, etc. And given the fact that now the geopolitical issues are so significant, and most of the economies, most of the regions are looking to spend more on defense, I think clearly you will continue to see a higher level of investments going into defense, not just in India, but also in other countries. And for Indian defense manufacturers, the opportunity is twofold. One, they can continue to cater to Indian demand, and also at some point of time, you will have export opportunities. So that's something that we have been very, very keenly watching. While valuations are on the higher side, we are not increasing our position at this point of time. But I think everything that is focused on aerospace, electronics, etc., and also explosives, which is going to be needed across the board whenever there is a geopolitical issue and a war, are the segments within defense where we have positions, and continue to believe that over a medium to long term, this is going to continue to outperform. However, in the short term, yes, the valuations are on the higher side, so one needs to have a little bit of caution.
Okay, and Harsha, well, earnings season just around the corner. In fact, we're right there. Give us a sense of what you're expecting for earnings this time around. Do you believe that we could do better than last quarter? Because expectations this time around too are rather tempered.
It's unlikely to be anything very exciting, but yes, maybe marginally better than the fourth quarter of last financial year is what we can expect. We do believe that the first two quarters of this financial year, we will be somewhere in the mid to high single digit in terms of earnings growth on Nifty basket. And eventually in the second half, they should improve to slightly better numbers and move into double digits, and thereby taking overall full year numbers to maybe 10-11% kind of year-on-year growth. So yes, I mean, if you're sequentially looking at it, maybe there will be slightly better numbers this quarter, but I don't think that's going to really excite the markets in a big way.
Harsha, so in the light of no expectations from earnings season, lot of paper supply, can we say that we actually should expect a downward bias now? I mean, next 2 quarters, because there are no triggers. Everyone knows that which way inflation is moving, which way tariffs are moving. If demand is coming back from FI, supply is coming from promoters. So are we in that what could be called as a nothing sort of a market or a very low return patch now?
Nikunj, frankly, last 6 months have also been more of that nature, and probably that could continue into another couple of quarters. And then once there is a little bit of confidence on the earnings trend improving or credit growth improving, that's when probably you will see more legs for the market. Having said that, I mean, the market volumes at this point of time have not been significant. So to that extent, any of the liquidity events can drive markets one way or the other. So that's something that one needs to keep in mind.
Okay. All right, Harsha, really appreciate your time. Thank you for joining us. Osho Krishna, Chief Manager, Technical and Derivative Research with Angel One joins us now.